There we go. All right. Well, Lisa, please do the honors and give Ali a little introduction. Tell us why you like him and why he's here, and then we'll give the floor to Ali.
Okay. Well, I have the honor of introducing Ali Nooshin with the Savvy Accountants. I met Ali at Realtor Quest in 2019, and I became his client in the fall of 2020. And I tell you, Ali and his team have made my life so much easier. I used to have to take 1 to 2 weeks vacation at income tax filing to get all my papers to my accountant. You know how it is with the shoebox and everything of receipts. And what I love about Savvy Accountants is I really feel that they care about their clients. I mean, Ali contacted me throughout the year, and he's always thinking about me and saying, did you think about there are these programs available through this pandemic? And there are different government programs that I might benefit from. And whenever I have accounting questions throughout the year, Ali always gets back to me within 1 day. So I think that's great. So without further ado, I'd like to introduce our guest speaker, Ali Nooshin.
Thank you, Lisa. That was a very nice introduction, and it's been a pleasure working with you as well. And that's exactly kind of how we like to operate, is to be proactive and just try to get everything in line before the end of the year for what I call the mad rush come April and June. So I'll just get right into kind of what I have here for everyone today. You can let me know if you can see my screen. Can everyone see it?
Yep.
Yeah, okay. So the purpose of what I've put together for this meeting is to I don't want to bore everyone with too much tax details, because everything can get a lot more complicated when you get into the details. What I've put together here is just like a quick nuggets or snapshots and summaries that can help you have a general idea of certain aspects that I think would be helpful for everyone in real estate business. So the whole point of this is that if you all work hard to earn your income, let's try to maximize it, basically. And you'll see there's information in here, but none of it is basically going into the nooks and crannies of it, because that's where we come in. So let me know if you can see it, and then I'll go on. So as in any presentation, there's always the standard disclaimer. This presentation is mainly just a general perspective. This is not meant to be used for accounting advice and so on. Please contact your accountant or contact us, and we can go in more detail with your specific situation. But this does give you that general idea of having an understanding of certain things that could be impactful for your business. The things I'll talk about, I've broken down into 5 categories. First, I've gone broad, and then we'll get more narrow and specific. So first, we'll start with things that are taxes in real estate transactions. So the land transfer tax, HST on sale of property, and non-residential speculation tax. Some of these you might know already, but there might be some refreshers too. Then we get into the real estate income tax, which is basically your income and the taxes and implications for it. Some things we'll talk about: sole proprietorship versus the new personal real estate corporation, HST on your commissions, and common expenses and deductions for everyone. Finally, after we've dealt with your income, let's figure out how we can maximize. And that's where we talk about spendings and planning and being ready for the tax time so that you can make the most of what you've earned. And at the end, we'll tell a little bit about us, and then I'll have closing remarks and questions at the end. So the first thing, I'll start with the land transfer tax. As you all know, it's payable in every transaction. It's paid by the buyers. And as an example, a $900,000 home would be about $14,500 in land transfer tax. Toronto has their own land transfer tax on top, so that makes it a $29,000 investment or cost. The good news is that there are rebates available, but that's only for first-time home buyers. And they can only get up to about $4,000 from Ontario and another $40,500 from the city of Toronto. So if you look at a $900,000 house, you're paying $29,000. You might be able to get, let's say, almost $9,000 back. You still have to pay $20,000 in taxes. There's a partial refund if the other buyer does not qualify, but those are special circumstances that we won't get into here. Now, HST on the sale of property, there's the 13%, which is the GST and PST. Now, all the prices you see in your houses usually have that in there already. But the key part here is that if it's substantially renovated, you should also there might be HST implications as well. So it's not just the new house. It's also if something that's substantially renovated, there'll be HST implications too. And you can get a PST rebate of up to $24,000 under certain conditions. If it's for your principal residence, you get that right back immediately. So there's no waiting period. But for investors, for your clients that are investors, they have to pay the full price up front and then get the refund by filing a form. So for them, they have to have the money available up front, whereas a person for principal residence, they don't. And finally, if it's an investor that does not intend on renting that property, they get no rebates whatsoever. There is, and I call this the federal government trying to be helpful, but not really being helpful in Toronto. There's a GST rebate available as well. And that kicks in at any less than $350,000. But if the property is worth more than $450,000, there's no rebate. So I don't know how many more things are left in Toronto at that price range. And then finally, the non-resident speculation tax. This one has a 15% tax that's given to the greater horseshoe area. And I've given a map of the region there so you can see all where it is. The tip of it is in the city of Orillia. It goes down to the Niagara on the south, and then the east is Scarborough and west is Brantford. The key thing is that both individuals have to be qualified to be exempted. If one of you qualifies, you still have to pay the full amount. There's a rebate available within 4 years in certain conditions. So if people that become permanent residents, they can ask for the rebate. The international students that are enrolled in school, they can also get the rebate. And foreign nationals working in Canada can also get the rebate. Now we'll get into the more things that directly impact you on a day-to-day basis, which is the kind of businesses that you have. So first, most of the time when you start off your business, you'll be a sole proprietor. And the reason for that is because it's easy to form and set up. It has simpler bookkeeping and reporting requirements because the business and you are the same person. This is a very important distinction. So when you file your taxes for your business, you're really filing it for yourself as well. It's one person. And you usually pay less taxes if your net income is less than $45,000 a year, generally. The downside to being a sole proprietor, you're personally liable for the business. And I'm going to get to that later on too. The second point is you can't defer your income taxes. So as an example, if you made $300,000 in a good year, all of that will be added on as your income for that tax year. There's no way to defer it or plan it around it. And finally, you pay much higher taxes as you make more to a maximum tax rate of 53.5%. So that example really comes in the more income that you're making. And the reason to become a personal real estate corporation becomes greater as your income goes up. So now we're going to talk about the new personal real estate corporation that just came into effect. This one is a separate corporation, and I'm glad that the Ontario government finally did this in line with other professionals. What this is that it's a separate legal entity. And this is the key important part, is that when you're filing taxes for your corporation separately than yourself as an individual. So as a result, there is more administrative work that needs to be done because you're basically keeping track of another person. But the advantage of this, you get great income splitting and tax deferral opportunities. Because in a corporation, in that same example, you made $300,000 that year, you can choose how much that $300,000 you want to take from your corporation. So you can say this year, you as an individual only made $80,000 and keep the rest in the corporation for a rainy day or for later on or for investments. There's other options you can do with that, but it gives you that flexibility to pick and choose how much you want to declare as income on your personal taxes. Whereas as a sole proprietor, you don't have that benefit.
Ali?
Yes.
Can I ask you a quick question about that? So let's say it's a big real estate team and the business generates, let's just call it $2 million in revenue. You as the owner of that team, or owner of the business, should you be just taking a salary regularly, or does it make sense to wait until the end of the year to figure out how much you want to or don't want to take?
That's a great question, and I get that all the time. And the answer to that is, ideally, you want to have a mix of both. And the reason for that is because as a salaried employee, banks love you. They make loans and getting things a lot easier because they see a T4. They go, okay, this is regular. I can rely on it and make my calculations and so on. The other benefit is that as a quote unquote employee of the corporation, you get a salary. And when you get a salary, there's other benefits that are unlocked in a corporation for you as an employee. That being said, dividend has advantages that kick in when your income goes above a certain threshold. So that's why the real answer is you take a salary for the amount that you need, and then the rest you do that as a dividends as the business progresses. And that way you can, right? And that way you can maximize both the benefits that an employee can get, because corporations have benefits for employees. So you can tap into that, and at the same time, still be able to defer income and get the other benefits that you would need for the year.
Mm-hmm. Okay, thanks.
So continuing on, the other benefit is that there are tax saving strategies that are not available to a sole proprietor. And the reason for that is because, just like we talked about, you're now an employee as well as a shareholder. So there's certain things that employees get as benefits from a corporation that individuals don't get from their own business. And finally, lifetime capital gains exception of almost $900,000. Now, this is indexed to inflation, but basically what it means is that for small corporations that are selling their shares, a certain element of that shares is tax-free. So in this case, as of 2021, is $900,000 or $892,000. So if you still had a very successful business and you sold your business, and let's say you sold it for $3 million, your shares as an example. Well, out of that $3 million, 900,000 would be tax-free. And then you would only be paying taxes on the remaining amount. Whereas as a sole proprietor, you don't have that benefit. You just sell your business and whatever you get is taxable. Now we're going to some of the downside of a corporation. So as a personal real estate corporation, you are still personally liable for the business. So that does not go away. And I think that's very important for anyone, because everybody thinks as soon as you have a corporation, you're off the hook if anything goes wrong. For the PREC, that's not the case. And then there is higher administration and reporting requirements, because now you're reporting as on a separate legal entity. So we have to file taxes for your corporation and yourself. And then the CRA may have questions on your corporation or yourself. So now you have more, I'll call it points of contact, potential points of contact with the CRA. And who doesn't want to talk to the CRA, right?
That no one ever.
Right. And then finally, the business losses can't be used to offset personal income. So one good thing is, in Canada, one of the things that they've done is they want to really spur small business owners to have that drive to create businesses. So what they've done is, if you have like a side hobby that you're thinking about doing, what the government says is, start it out, and we get you're going to have losses at the beginning. That's fine. If you have losses and you're making income, you can offset against your income. So as your business has a loss, at least you know that you're saving on the tax on the income that you would have gotten overall. That's as a sole proprietor, because the whole idea is that if you're going to start this thing, you're doing it on the side, you're an individual. When you become a corporation and your corporation has losses, you can't use that to offset your personal income. So any losses in the corporation will be staying in the corporation. It can only be used to offset corporate gains. Because again, it's also a separate legal entity. So usually for this reason, I say, if you're starting out your real estate business, be a sole proprietor. Don't get yourself into it, because if you have a side thing you're doing, or if there's any losses, you can at least offset that against your future income. But the minute you make it a corporation, if you have losses at the beginning because you're just starting out and you have expenses and you're trying to make something work, any losses will be stuck in that corporation, and only when your corporation actually makes money can you utilize those losses. So now we're moving on to HST on your commissions. So the key thing here is that when you get your commission, you get your compensation for the commission piece, but then there's also HST on top of it. This part, the key part is that the HST is owed to the CRA. It is not meant to be used by you. And why I say this is because at the end of the year or quarterly, depending on what your taxes are due for HST, you would calculate all the HST you took in from your commissions, and then subtract all the HST that you paid out for your expenses. The net difference is what determines whether you will get a refund or whether you have to pay taxes on it. So this is the part that becomes important is that some agents will offer cashbacks for their clients. They'll say, buy with me and I'll give you the full commission on the sale back, and then you'll buy with me instead, and that way we'll use that. The key part here is that because your commission includes the HST, always set aside the HST from your commission, because the CRA does not care whether you gave it to somebody else or not. They're going to hold you liable because they're going to say, you received the HST, you still owe me the HST. So that can get you in a situation where you paid out your HST and now you have to pay the government the HST as well. So you got to hit twice. So I think that's very important to just keep in mind when you want to have these deals or in terms of cashbacks and reduced rates and so on. Now the common expenses. So this is, I call the more popular list. This is not exclusive and exhaustive. So generally, some of the things that you can deduct on your business expenses are meals, entertainment, but only to 50%. And I made a little note here that gift cards are included as meals and entertainment gifts. So if you have LCBO gift cards or gift cards to restaurants, they're included at only 50%. Vehicle leases and purchases, vehicle maintenance, those are all deductible. House deductible, courses and tuition, advertising, and finance charges. Some of the things and limitations on what is deductible for your expenses to offset your income: clothes. So unless you're a welder, for example, that has special clothes that are just for welding, you won't be able to claim your clothes as a deduction. Personal grooming counts under the same category. There's a limitation on car leases and car purchases. So any car lease payment that you're paying over $800 a month on, you're not going to be able to benefit any more than that. Vehicle costs over $30,000 before HST, anything above that is not going to be deductible. And just a little point about that vehicle cost, that number of the 30,000 came into effect back in 2001. So in the past 20 years, that number has not changed. And the government considers anything over $30,000 as a luxury vehicle. And finally, fines and penalties by the government are not deductible as business expense. So we've talked about now some of the taxes in real estate. We've talked about taxes for your income. And now we're going to talk about some of the things you can do for your growth, planning your spending, fueling and growth. One thing is, as you know, is that commissions can be highly cyclical and erratic. So it's important to spend carefully and have enough for rainy days or unexpected things that will come up. You want to set aside enough of any HST you owe as you're getting your commission coming in, because you could end up paying tens of thousands in HST and then income tax on top of it, come tax time. So it's a lot easier to have something set up after every transaction than to have this large ballooning payment at the end of the year. And it's continuous, because the next year will be the same thing if you don't kind of keep track of it. And then you will have to pay income tax and CPP when you file your taxes, which could be tens of thousands. That's why you say to plan accordingly. So some of the things that you can invest in your income on are taxes for non-registered accounts. Now, this is the part where I'm going to just give you a little bit of details about how taxes work for your investment. So if you put it into just an account that's not registered, not an RRSP, not an RESP, anything that's just a normal account you're opening up, there's a degree of how taxes are treated on the income that you make. The most taxable is interest. So bonds get taxed the most. Every dollar that you earned on your bond interest payment is added onto your income. The next one is dividends. So compared to bonds, dividends have a more favorable tax treatment, but not much. And then finally, capital gains is your best investment in terms of non-registered accounts, because only half of what you gain will be added onto your income taxes. The remaining half you get is tax-free, you get to keep. And the good thing with capital gains is that you also have offsets. So you can have capital losses that can reduce the amount. So if you have a couple of investments and some of them are doing well, some of them are not, you can offset them from each other. Whereas with interest and dividends, there's not a lot of cases where you can do the same strategy there. So that leads me to the registered accounts. And this is where these become handy for you all. My favorite one is the RRSP because it is a very effective tool to minimize the tax you have to pay, because every dollar, it's twofold benefit. When you put into an RRSP, you get the benefit of the higher income reported for banks, for loans and mortgages. But at the same time, every dollar that you put into your RRSP is a dollar that gets reduced on your income for what you owe in taxes. So if I, as an example, if I made 150,000 in income and I put 50,000 into my RRSP and I deduct that, then to the banks, I will be saying I made 150,000 as my income, but for tax purposes, I would be paying taxes only on the 100,000, not the 150. And the other benefit of RRSP is that you don't have to use it in the year that you put the money in there. So a good strategy could be to put some in every year, and then when you need it, use it. You don't have to claim it that time, and you can use it any years in the future until you're 71. So there's like a window to it, but the benefit of it is that in a year that also you have an unexpected large amount of income, you can use it then, because you can only use it one time. You can't use it over and over again. So plan accordingly. Tax-free savings account. This is my second favorite one. And depending on the income that you have, one may be better to invest in first between RRSP and TFSA. Now, I call this the rainy day fund because you can take money out anytime you want from the TFSA, whereas the RRSP, because you save on the taxes when you go in, when you take it out prematurely, it gets added back on as income. Now, one key thing about the TFSA, the IRS does not have a special rule for TFSAs. So although the Canadian government doesn't tax anything in there, the IRS does. So if you have US stocks in a TFSA account and they pay out dividends, you would be subject to a 15% withholding tax on any dividends that you get. And then the last one is the RESP, and that's meant for funding your kids' education. And this one, it's a great program because anything you put in there, the government will contribute 20% on the first $2,500 that you contribute into the RESP. The government will top it up by 20%. That's universal. It doesn't matter how much income you have. On top of that, if you're considered low income, you can get additional top-ups by the government. So at its worst case, you're getting 20% added in from the government for your child's education. And at the best case, you're getting even more than that. So now that we've gone through everything there, this leads us to about us and about some of who we are and what we do. So we are specialized. Our expertise is in finance and accounting. My background itself is I've actually been on both sides, so I've done a lot of this. Our team has over 50 years of combined experience. We are focused on entrepreneurs and small business owners. And what we do is, part of the reason why I started this was because I wanted to find a better way of doing it. We are not your typical accountants. We don't have shoeboxes. We don't have stacks of paper everywhere. We're cloud service based, so we leverage technology. We try to make life as easy for you as possible. And at the same time, we are based in Scarborough. So we do have a physical office as well. We are about inclusive pricing. So our price is inclusive of unlimited advisory services. You contact us anytime, and any finance or tax question that you have, that's what we're here for. One of the things that I hated was telling clients, why don't you do this at the end of the year come tax time? And it's, well, I didn't know. And that's why we say, well, use us. That's what we're here for. We do all types of tax services from HST filing, income tax filing, payrolls, estate planning, and anything else you may need. And finally, we are financial advisors. We work with our clients. We ask them what their goals are, and we help them get to that point, both from a finance perspective and from a tax perspective. Now, I love this quote that if you're proactive, you focus on preparing, and if you're reactive, you end up focusing on repairing. So we focus on preparing our clients. And how we do that is that we are accessible. So we're in constant, like I am not exaggerating where I say that we are regularly talking to all our clients, maybe once a month or once every 2 months on an ongoing basis throughout the year. We are open 7 days a week, and our response time is between 1 or 2 days. We are insightful. Our clients have, so part of the things that we do is we give real-time access to our clients to run reports to see how their business are doing anytime they want. And then we give actionable meaning behind those business numbers, because we have a semi-annual financial review is what I call it, where we actually sit down or virtually meet and just go over the business and say, this is how it's been so far. And then give it a projection and perspective on where it's going to end up at the end of the year. And then work with you to figure out whether that's in line to your expectations or not. And if not, let's see how we can do to get to that point. And we also work with our clients to create budgets and forecasts. I've been doing all of those for big corporations, so might as well I'm bringing that to small businesses as well. And finally, we're transparent. We have fixed pricing, and we charge monthly, but we don't bill by the hour. And our clients have direct access to read-only folders with all our work, and all support information is in there. And we merge all digital receipts and supporting documents to their transactions so that they're able to see exactly. So, because I've had a lot of conversations where they'll say, I don't remember spending that. And then I'll say, well, here's your receipt right there. And then they'll be like, oh, yeah, I remember that now. Yeah, I did spend that. So we do that. And then that's part of I'm a big proponent of being transparent for that reason. And it's just in the corner there, you'll see those are some of the typical reports we created for some of our other clients. So we do, for example, projections on income and expenses throughout the months to see whether there's any seasonality or whether there's big things that are coming up. We create custom ratios to measure certain things that are meaningful to each individual's businesses, and we'll track that for them. And finally, we do the P&Ls and go over the differences with those as well. So just the closing remarks on this is that you earned it, maximize it. So real estate transactions, there are rebates available for the land transfer tax, HST, and the non-residential speculation tax under certain conditions. Consider forming a PREC when your net income supports it. I can't stress this part enough. Don't just go out and creating it, because there is cost to it, and then the benefits that we already went over, you may miss out on some of those too. And then make sure you set aside enough to pay your income taxes by year end, because it could be in the tens of thousands, and register accounts are a great way to help you get there. So with that, I'll open up to any questions.
I have a question, Ali. It's about
Yes.
the new construction and HST. I just wanted to make sure that I understood clearly. So if you do rent long-term, then you are still entitled to your HST refund?
Yes.
Okay.
It's
What do you have to do?
So you have to fill out a form, and you have to submit it to a CRA, and then they have to approve it. As an investor, that's what you have to do.
So we're closing on our new construction property. At the time of closing, we are going to have to pay that HST. It's going to be part of our closing costs. So we've got the land transfer taxes, and then we have all the extra costs for new construction, and then we also have to have funds for the HST. Then we apply for it, and they rebate it. And do they have to wait the 12 months to rebate it?
Yes. It might not be 12. It'll be until the CRA approves it.
So when do you apply for it?
Sorry?
When do you apply for it?
When it closes.
when it closes.
After, because you have to first have ownership of it and
Right.
have paid it out to be able to claim the deduction or the HST for it.
So if you have that period between interim occupancy and registration, I'm asking because we literally just got a tenant in during our interim occupancy in a building, and we have another one coming up in June. And so we have a tenant, we have a lease. So when we actually register, we're going to provide a copy of that lease to CRA and say we have a long-term tenant, give us back our HST. Okay.
Yeah, exactly. Because until it's been registered, you don't technically own it yet. Technically, it's still
Right.
owned by the
Yeah.
corporate, the builder. That's right. So
What if it takes 6 months to register and my tenant's already been in there for 6 months?
that's I mean, you haven't paid the HST yet. So it
Right,
doesn't matter.
but okay, so sorry. So let's say, so I've got my tenant in there. Let's say it registers December the 1st and I provide a copy of my lease, but my lease says June. So it's like June to December. Do you have to provide another lease that's from like December to December?
No. As long as they know that, so if you're planning on renting it out within 12 months of you taking ownership of it, then you are fine. You're able to claim the rebate. It's only if you say, as an example, I'll use BC in Vancouver. They had a lot of problems with this, was where a lot of foreign buyers would buy the properties and just leave them empty. Right? It won't be rented. It'll just be empty properties. And there's a housing problem in Vancouver, just like in Toronto. So, and there's all these available empty houses.
Right.
So that's where it became, no, if you're not going to rent it out afterwards, then you're not getting a rebate for it.
Right.
Okay. The key part here to keep in mind is that the builder, whenever they advertise the sale price, they've already included the rebates and everything else in there because they're assuming most of the time they're selling it to a principal residence, someone who has a principal residence. So when you're looking at your purchase price from your builder, it will get adjusted because the builder has to work backwards to get it to the original price until you get your refund.
Right. And then is the builder involved in the refund at all?
No.
Okay, great, thank you.
No problem.
I have a question.
Yes.
For Keller Williams has a conference next year in Orlando, Florida. If I want to go on vacation after it, can I deduct my flight, my conference costs? What else can I deduct?
It's a great question. And the answer to that is it depends. I'll give you general. Generally, so one thing people like to do is go on the conference and bring their spouses, as an example. In those situations, only your own portion can be deducted, not your spouse's. That's one thing to keep in mind. The other part is that you have to prove that you were going there anyways, and you didn't end up going there because of the conference. So Sarah has a lot of things behind intent. What was the intent of your trip down there? So if the intent was I'm going to a conference, it's treated different than the intent was I'm going on vacation. Oh, my conference is there as well.
Okay.
So it's not a clear one, but but that being said, one thing to keep in mind, you are allowed up to 2 conferences a year that you can go to that are deductible, but only 2.
I didn't know that.
You do. There's a limit to the conference that you can go. That are like destination conferences.
Right. Oh, I totally didn't know that. We always write off. We're at least 3, sometimes 4 conferences a year each.
Again, I'm saying general, so maybe it's a special sort. I don't know, but I just say that generally they try to limit that to 2 a year.
Got it. Thank you.
Ali, I have a quick question. Do you have any advice for a new agent to keep track of their HST?
Yes. So we use a lot of the softwares that we do. So I'll say some of the ones that we do is we use QuickBooks Online and Xero. Those are the ones that we use, and they're great for keeping track of your expenses.
Okay, awesome. Thank you.
I have 2 questions. The first one is related to HST. So can we write off HST for maintenance for the car?
Yes, yes.
So when we
So
do it-
anything that's a business deduction, you're able to write off the HST that you paid for that as well.
Mhm.
The HST is treated separately and differently than the HST and then the expense itself.
Okay.
But keep in mind, this part is that for meals and entertainment, only 50% of the HST is deductible, just like the expense itself.
Okay. And the other question I have is, I'm not sure what you know about this, is for non-residents. When they purchase a home in Canada, but they are not from Canada, but they are moving here and they live here, then starting to live permanently. I looked a little bit into it, but I thought I'll ask if you can explain how this works. I've read that they can, they have to pay 15%, I believe, when they purchase a house on top of the purchase price, and then they can,
Yes.
once they can prove that they moved into the house or the home, then they can request the refund.
Exactly, and that is correct. So within 4 years of when they purchase that property, they can claim a refund.
For 4 years.
Yes, within the 4 years from that point of the purchase, yes.
Okay, and if they move in, do they have to? So I guess, but they have to move in right away, or?
No, they pay the tax up front, right? Because they're not a resident yet. And then they'll apply for the rebate once
But
they're here.
Yeah, so they can apply right away, basically, once they're here.
Yeah.
Okay.
Once they meet the conditions, once they prove the conditions to be exempt or get the refund, then yes, but not before.
Okay. Thank you.
And actually, that does bring up one point I'll bring up for foreign buyers is if you have a client that is buying a property from a foreign buyer, so the property you're buying is being sold by a foreigner, owned by a foreigner. There is withholding taxes that CRA will be taking from them. I think, Irene, you know where I'm going with this one.
Yeah, absolutely. And you need to make sure they have enough money from the sale to actually hold those funds back.
Yes,
Yeah.
because if you don't, and the CRA doesn't care how much duty you took, because at the end of the day, they'll look at it as if that person, we'll call the foreign seller, did not pay the 25% of the purchase price, then your buyer will be on the hook for it, even though they have no relation to the transaction whatsoever. So that one is very important to keep in mind, and you can the duty of care falls on you and your lawyer on the real estate, but it's not a case of I tried, I didn't find it. It's got to be exhaustive because they're dealing with large funds.
Yeah, so if you're the listing agent, you need to find that out when you take the listing, not when you get to closing. And if you're the buyer's agent, then you need to grill the listing agent to make sure they did their due diligence, because it could cause a lot of problems on closing. Yeah, we had, not us personally, but we had a situation in one of our other offices where there was another agent that came up against this at closing. It was her listing and she didn't do the research.
Yes.
Yeah,
Yes.
and then the sellers were in a pickle.
Where?
They were in a pickle because the buyer said, "I'm not doing that." Like it was a mess. It was a mess.
Yeah, yeah.
I think
Exactly.
they ultimately worked it out, but it was very, very stressful.
Which leads me back to transparency. Transparency is key.
So
Yeah.
just so that I understand this correctly, if it's a foreign seller, and what was this with the 25%?
Withholding tax.
Withholding. So they have to, what does it mean? So they withhold 25% of the purchase price? No. Yeah?
Yes, yes. So just to give a little more detail about it, there's as a foreigner that has a property here, as a foreigner, the tax obligations are for real estate property is 25% of the purchase price. So if I paid that and I don't file any taxes, the CRA is fine. They say no problem. That's good enough for us. However, the reason why the CRA does this is because as a foreign seller, if I file a tax return with the CRA, I can get some of that amount withheld back when I declare how much rental income I made and I declare how much my costs were to offset that gain. So that then I'm only paying taxes on my actual gain, not as opposed to 25% of the purchase price.
Mm-hmm.
But that money has to be held back by the lawyer in the event that the seller tries to do something shady and not pay it.
Yes, there is an exception to this. One workaround for is that the CRA, so if your agent or the lawyer can contact the CRA to get a letter of opinion. So if you basically file ahead of time and give them the information up front before the close, what this CRA will say is they'll give a letter of opinion to your lawyer that says they are agreed to file it beforehand. They've done their due diligence. You can release only the amount that they need to. You don't have to withhold 25%, but that has to be done proactively by the seller or by the foreign seller.
The seller, yeah, the seller's lawyer. There's a question in the chat, Ali. Do you know if there is the foreign purchaser tax if someone has a work permit and has already applied for their PR card?
No, there's if they're working in Canada for the purpose of employment, that's part of the exemption or the rebate.
Thanks, Janice.
But that means they still have to pay it, but then they apply for the rebate, correct?
It depends on the situation. If they're still not here yet, it depends, right? I know it really depends on what information you have at that point.
Okay, so when they are here already and then purchase something,
yeah,
then they have to, then what?
so if they're here already and they already have their work confirmation, then they don't have to pay the foreign buyer tax.
Okay.
Right? Because they have all the supporting documentation behind it.
All right.
So, and they're a permanent resident and they don't have to pay it either.
Mm-hmm. And then I guess the key is that they have their bank account here in Canada set up.
Show ties to Canada, so it's a question of fact whether they meet the criteria or not. Like, that's where it becomes more, it depends, right? Mm-hmm. But generally, again, this is a general focus. It is that if you have employment in Canada, if you are going to be living here, or you're doing schooling here, those are all valid reasons to get the refund.
You're saying refund again, so that means you have.
Yeah.
You don't have to pay
yeah.
Okay.
It really depends on the nuance there, right? Okay. So yeah.
I have a question about the expense deductible. So most of real estate agents are working from home, especially during the pandemic. So my question is, what part of a house maintenance is considered as a like a expense to be deductible from the income?
Anything so if internet, I'll give the common ones: internet, hydro, water. Those are all based on a percentage of the office space that you're taking up, or your business portion. So how it works is, let's say my hydro, my internet, interest expenses on mortgages, they all total, let's say, $50,000. And let's say that 10% of my house or condo is my business portion. So as a result, I'm able to claim a deduction of 10% of the $50,000. So $5,000 is what would be considered as my business expense to deduct my income from my business.
Okay. How about other maintenance expense? For example, your the driveway needs to be paved and the new paint, that kind of a house related renovation stuff, are they considered part of a home office expense?
Great question. So if your office is a place where you meet clients regularly, and their definition is typically like 1 to 2 times a week, like you have people that are actually your clients are coming in through the house and going through you and meeting you at your office, then yes, painting the hallway that goes to your office is included, and all the other deductions that like driveways and stuff would be included as well. But if you are just doing your work in your office, you're not meeting clients there, then they wouldn't be deductible, because what does the driveway have to do with your business from a business perspective?
Okay, yeah, thanks.
If I have a question further to that. If I don't have clients coming to my house, but I use my kitchen as my lunchroom, my coffee room, can I deduct part of that? I know
Great
my
question.
office. Yeah.
Great question. So my response to that would be that it's not in your best interest to do it that way. The CRA has different methods to calculate what is your business use of your house. It's the same as even they have different ways of calculating for the portion of a house that's renovated. It could be based on number of rooms. It could be based on square footage. There's 3 different methods that they can be used, and they're all accepted by a CRA as long as it's, quote, reasonable. The reason why I would say you don't want to do it, you're utilizing your lunchroom, is because then you're getting into the hours of the day that's for business to the hours of the day that are for personal. Because what the CRA will say is, if you want to go with that method, sure, tell me how much of that is, how much in a day, how much of that is used for business versus how much of that is used for personal. And then only the business portion from the reduced portion can be used. So that's why typically it's better to just say, here's my square footage. Here's the portion that's for business that I use exclusively for business for the most part during business hours, and then leave it at that.
Okay, thanks.
Does that make sense?
Yeah, thanks.
What happens then if you claim a portion of your house, including maintenance or whatever, for business, and you sell the house?
So another great question. As long as you're deducting expenses, you are fine. Expenses would be maintenance costs. It would be condo fees, right? Anything that's throughout the year. What you want to avoid is depreciation. You want to, if you have a principal residence, you want to avoid depreciating anything, which would be, for example, depreciation on the building, the value of the building, right? As long as you don't do that, as long as you're not claiming capital costs, you can claim, and when you sell your property, 100% of it will be exempt from, it'll be considered as your principal residence and you'll be exempt from it. But if you start claiming capital cost allowances, that's when they're going to say, well, then now you got to break it down between how much of it is personal and business, and then you got to pay income tax or capital gains taxes on that portion. So the best advice I would say is stick to expenses that you use throughout the year, not long-term investments, because those are things that get capitalized.
Okay, and then it's a portion of that, obviously.
Based on the portion that's business, yes.
Okay.
I have a question on the business at home, Ali. So we have in our home, I've had my own home office since we moved here, and one room in the basement up until December of last year was a real office. My whole team was working out of it. And from December, when my mother-in-law moved out, they literally took over almost the whole basement. So obviously for 2021, the business portion of my house expenses percentage is going to go up. So is there a risk that that's going to raise a flag for CRA?
Great question. Oh, you're all full of great questions today. All right, so the CRA is not in the business of giving away. They're here to tax.
Yeah.
So the higher that you claim, the more you risk scrutiny.
Mhm.
It doesn't mean that they're not deductible or allowable. It just means you're raising the threshold for them to say, let me take a second look at it. Because one thing that the CRA does is two things they do. They look at when you file your taxes and you send it into them, they're going to look at the reason why anytime we file our taxes, we have to tell them what industry our client is doing their business in. Real estate agent, mortgage broker, contractor, whatever it is. The reason for that is that once we submit that code, they're going to compare that individual against their whole spectrum of everybody who's filing their taxes.
Yeah.
And if you're in the average, probably fine, no problem. But if you get becoming the outliers, then they'll say, I want to get more information about this. Something, I mean, they're doing it different than 95% of the ones here. Why is that? I want to know why. So that's one thing that they do. And that part that falls into your expense and income and falls into how much you're claiming. So if you're, let's say, if everyone in your industry on average claims 20% of their house for business use, as an example, and you're claiming 40, you might stick out. That's one. The other thing that the CRA does is that they look at not just your income that you're reporting, but they look at your lifestyle. They say, so as an example, this is in the news, it just came out, but a lot of YouTubers that are in Canada, they've been successful, but then when they file their taxes, they of course zero income. So the CRA will actually say, well, if I look at a YouTube channel, you're in front of a Porsche, you're living in a mansion, but you only reported 20,000 of income.
Right.
So how are you able to support all that on $20,000 of income? So they look at your quality of life to see if your quality of life matches to what you show on your income tax. And that's the same reason why when you put in your, you open a bank account, they ask for your SIN number, because then they can link it to say, this is how much is in their account, this is how much they're reporting. Does that make sense or not?
The challenge is writing off as much as you can without it being too much, right?
Exactly. And even if you're writing off more, it's legitimate, it's fine. It's just you're opening up the threshold.
But you
One
know
thing-
what? Even if you have the legitimate expenses, just that opening up and the rigmarole that you have to go through when they open up any sort of investigation is ridiculous. They went on a witch hunt with us last year. We have two different corporations. One's a holding company. One is just like, it was just like a management company, and they haven't been doing anything. They're just shells. And after owning them or having them open for 10 years, all of a sudden somebody decided that in 2019, we were employees of that company.
The CRA decided that?
Yeah. And it was like 6 months of stupid forms, like just ridiculous stuff that had nothing to do with us. And they don't email, and they don't give you a phone number where they call from. So you have to fax, you find a fax machine. And like, it was so, I had to just give it to our accountant, because every time I saw it, my blood would just boil. And I was like,
I know the feeling. And one thing that I'll say is my favorite is when we call them, they'll go put you through a bunch of touchstone, like press 1, press 2, press 3, 2 minutes. And then they'll say, our lines are busy, call back later, and hang up on you. And they have a callback feature. You'll say, okay, I'll take the callback feature. They'll say, the callback feature is full, call back later.
ah,
And you go through 2 minutes of dialing before they actually get you that point. No business would ever survive the way the CRA is run. Imagine telling your clients or customers, call back later, we're busy. Like it wouldn't work. But whenever you deal with the government, it becomes a different matter altogether, and everything is slow. I actually had a client who we did their taxes for 5-6 years at one shot because they didn't file it. We filed it in March 2018. That's when we filed those returns. It just finished now, this month.
3 years.
3 years. And in the meantime, interest is racking up on his account. And I keep telling him it's okay. It'll go away once, but it's stressful because you don't know what they're going to cut off, what won't be accepted. But it's just So I know the feeling. I believe me, I know.
Yeah, no, it's not good. Sorry, I'm monopolizing the conversation.
No, no problem. Is there any other questions?
Well, Ali, I think this was really, really helpful. Can you put up the last slide that has your contact information? Just in case
Oh, yes.
anybody actually wants to get a hold of you. Perfect. And then if you're watching this recording and you have any questions for Lisa, who's got an IV to Ali, then you can reach out to her, and of course reach out to me if there's anything that I can do for you in the future. Ali, thank you very much. Really appreciate your input.
Thank you. It was a pleasure.
Great. Have a good afternoon, everybody. Bye.
Thank you.
Bye, everyone.